Hello everyone, and now we are going to go over to the next module, one of Ledger's premier offerings, which is the InvestmentLab. This helps people to create or generate optimized portfolios so that they can make efficient investments, because after all, efficient investments add up to an efficient economy. As you can see, here you have the same layout. On the left, a bare bones description of exactly what is being offered as an output, and on the right there is a soundless video which you can see at will and whenever you feel like. All you have to do now then is follow the few steps. The steps are described in the video as well. So you need to just choose the assets. Suppose we choose a bank, SBI. We choose NTPC. We choose say Tata Steel. And let's choose something else, something like Reliance. And we are going to allocate say 2 lakhs or 200,000 INR. So the two sliders over here are going to give us are just indicators for ranges. The first one being that for the level of returns which the user is expecting, and the second one is for that about their risk appetite. And let's hit submit and see what happens. So immediately the optimization is on course, and within a few seconds, yes. Okay, so these are the 5 different options by the 5 different algorithms as listed over here, being offered right over here. Each of the algorithms has its own characteristics, own considerations, and own boundary conditions, and each of them have their data derived directly from the historical data of each of the stocks that have been provided right over here. So now, if we scroll down a little bit, the first diagram on the left gives you an idea of which algorithm gives you a greater return against the other, aka a comparison between the different algorithms. Now, this is an interactive graph. You can make it full screen. 1 second. Yeah. And at the same time, you can just remove one and see how the other would perform in its absence, or just keep this one and see how HRP, SVR, and COVAR stack up. So yeah, they're pretty much very close. Now on the right is something very important, which is how have these stocks performed on a daily interval basis historically. And let us focus on this region. Yeah, there you see, you can just make it full screen, and then you see every cluster is a cluster. I mean, every cluster of, say, I think we've selected 4 stocks. So every 4 stocks, every cluster is a day, and these are the plots. We can pan through it and see how they have performed through time. On the left you have your percentage returns, and on the bottom you have your timeline. And finally we come to the curve, the plot, which says how would each has contributed generally, as in like how much returns potential does each individual constituent stock have. And finally we come to the risk profile or the covariance map. This is extremely essential because it gives us a clear picture of how much interdependence there is amongst the securities concerned. which would mean that if one of the securities were affected negatively, how would it affect the others, and so on and so forth. It has also been color coded, and we can all see that it also has values. So these two shades, although they might seem very similar, they are not. So if you like full screen that, yeah, you'll be able to see the color difference. If we also look at the values, you can understand which one is more dependent on which. For instance, the dependence of Tata Steel and Reliance is around 0.007. Yeah, but between Reliance and SBI or NTPC, it's 0.0053. So definitely Reliance consumes more from Tata Steel compared to NTPC. Alternatively, you can look at how SBI is related to each of these companies, as in like for NTPC it has a coefficient of 0.0097, and for Tata Steel it has something around 0.0108. So this is way more dependent than this on SBI. Yes, we will discuss these things in a video later. Let us move on. Next come the main part. Here we are presented with the 5 options. The layout is very clear. On top, first you have your expected returns, but at the same time, the specialty of each of the algorithms is that it also tells you your risk exposure or the amount of volatility you might get ready to face. On top of that, it clearly calculates out the Sharpe ratio and presents the whole thing. On the left, you have the numbers vertically arranged with the remaining funds right over here, and on the right you have a neat plot wherein percentage wise it is visually shown as to, you know, according to this algorithm how the allocation should be. Now this can also be, you know, made big or downloaded. Now at the bottom, regarding the algorithm which has been used, the rationale, the mathematical rationale behind it has been briefly explained over here, and why those considerations have been made have also been elucidated, and these bubbles are there for every algorithm out there. So if you want to know more about the critical line algorithm, first read the bubble. Yeah, and at the same time, let's look at the next one. For the second option, this is HRP. From reading the bubble, I get to know that this does leverage in graph theory, and it wants to build a diversified portfolio, which means that this is marginally risk averse, but at the same time it also depends on clustering hierarchical structures, as in like it wants to find out the hierarchical relationships between different securities and how they behave, as in how one would be affected if the other's price had changed by a certain percentage. And it also gives you an optimized allocation according to the efficient frontier and our analysis. It also gives you its calculated Sharpe ratio. Here it says 31%, whereas the first one was like around 47.13%. The main two differences between these two is that this one, the mean variance optimization, the others are variants of that, or say developments over this fundamental model, is that this assumes that the stocks are going to behave in the same manner this year as well as they had done the year before. So now the third one is the critical line algorithm, and this is a very different algorithm, and it's also very rare, but it's also notorious because when it works, it does produce outstanding results, and that has been reported many times over. And finally, we come to the last two very conservative algorithms, which takes into account all the interrelationships between the securities, their price movements, the behavior, seasonality, everything. And the first one is the conservative one, called the efficient semi-variance optimization. So it says that you're going to actually get, in reality, around 29% returns against a 14% volatility exposure. And it does the calculation via a similar ratio called Sortino ratio, which it lists over here. As we know, for the Sharpe ratio, anything over 1 is a positive, is an investment which would result in positive returns. The same goes for the Sortino ratio. Now, the fifth one is different. It considers all kinds of interconnected risks and accounts for how how each security in unison or in bundles or in groups they might affect one another in different times, and it takes into account the other factors as well. It gives you a moderately accurate, I would dare say, since results so far has proven the same, and the layout is the same, and you can see that you have minimal funds remaining. And here is something important to notice. Other than the annual expected returns, this has a different metric. It's called the conditional value at risk. What this means is that this is a percentage, 2.82, to which the base capital will fall under conditions of maximum risk, aka, or in other words, when the portfolio is going through really bad times and everything is doing poorly, the maximum losses that might be had are 2.82% and nothing more, and the annual expected returns are so this one can research each and every algorithm, and we'll be adding more and more variants of optimization algorithms with time, because the intent is to make people invest not based on stocks, but based on say understanding risks and understanding what they're doing, because every time the returns, they come out always as more lucrative compared, and we seem to overlook the risks involved. However, this is a sincere endeavor which would help anyone who's active in the markets or even inactive to generate a portfolio and sit tight and enjoy consistent returns, given that market conditions are normal. Thank you very much for your time, and this has been a brilliant presentation opportunity that you've provided to me, so that I can explain my our perspective to you, so that you have a clear idea as to how to use it, how easy it is, and how much difference you could make to your fundamental wealth and grow it via the investment lab of Ledgr. So sign up or sign on or hop in. Yes, buy those tokens, and see, Ledgr works like a vending machine, and I don't think a few tokens is worth even a few fractions of what you're going to earn with optimized portfolios. Thank you very much for your time, and we shall correspond soon. Thank you. Goodbye from Team Ledgr.